When a central bank speaks, markets move, but probably not in the way you think. By the time most traders react to a headline, the big money has already made its move. Today, I'm going to break down the full chain reaction for you, from global macro events all the way down to the candles on your chart. This is the flow from macro to micro. It all starts with the macro trigger. Think about things like interest rate expectations, tariffs, inflation data, or geopolitical tensions. Now, here's the key. Markets don't move on the events themselves. They move on shifts in expectation. For example, if inflation data comes in hotter than expected, the market starts pricing in a higher chance of a rate hike. If new tariffs are announced, supply chain costs are expected to rise. Markets are forward-looking pricing machines. When these macro expectations shift, the first place you'll see the reaction is in the currency layer. Currencies are the transmission system of global capital. Stronger interest rate expectations usually mean a stronger currency. A risk-off mood in the market often leads to higher demand for the US dollar as a safe haven. This is crucial because a strong dollar can push commodity prices down, while a weak dollar often helps gold prices rise. This brings us to the commodities and inflation feedback loop. A spike in oil prices doesn't just mean you pay more at the pump. It increases transportation and production costs across the board. This feeds into inflation data, which then forces central banks to adjust their policy. That policy change affects currencies, which in turn impacts how stocks are valued. It's a chain reaction, and this is where most traders fail to connect the dots. Finally, we see the impact on equities and other risk assets like crypto. As a general rule, lower interest rates can lead to higher stock valuations, while higher yields put pressure on growth stocks. Liquidity is oxygen for the market. When it expands, risk assets breathe. When it contracts, they suffocate. So, how does all this show up on your chart? It's not random. The liquidity sweeps, the accumulation patterns, the breaks of structure, they all reflect the large-scale repositioning of capital we just talked about. This is where structured analysis matters, not headlines, not emotion. Structure. Most traders watch the candle, professionals watch the capital. When you understand the chain from macro to micro, you stop reacting to the market. You start anticipating it. Think like capital. Thanks for watching.